For things just happened. Talks with Iran deteriorated again, removing the illusion of new-term regional stability. The latest U.S. PPI print came in hotter than expected, signaling upstream inflation pressure is not cooling the way policymakers hoped. Israel shifted into visible evacuation posture, a move markets interpret as preparation, not rhetoric. And silver futures quietly expanded open interest while price volatility remained compressed. Most people are treating these as separate stories. They are not. They are one macro event unfolding in layers. Geopolitical instability feeds energy risk. Energy risk feeds producer prices. Sticky producer prices constrain policy flexibility. Policy constraint amplifies demand for real assets. Silver sits at the intersection of all four. It is monetary. It is industrial. It is financialized through derivatives. And it is globally traded in both paper and physical form. Right now, the silver market is not euphoric. It is coiled. By the end of this breakdown, you'll understand why the $94 discussion isn't fantasy. It's a conditional scenario based on alignment between policy pressure, minor margins, physical demand, and options positioning. And more importantly, you'll understand what would invalidate that thesis. Let me show you what's actually happening beneath the surface. Policy. Government action. Let's start with policy. When Iran negotiations weaken, the market does not just price conflict risk. It prices energy corridor uncertainty. The Strait of Hormuz remains one of the most critical oil transit choke points globally. Even marginal risk premium in crude feeds directly into diesel, shipping, refining, and industrial input costs. That shows up in PPI. Producer Price Index is upstream inflation. It reflects what manufacturers and industrial operators are paying before goods reach consumers. When PPI runs hot, it suggests cost pressures are embedded deeper in the supply chain. This creates a dilemma for the Federal Reserve in the United States. If inflation remains sticky, aggressive rate cuts become harder to justify. If rates stay elevated while geopolitical risk rises, real yields do not move in a clean downward trajectory. They become volatile. Silver performs best not simply when rates fall, but when policy credibility becomes uncertain. Add to this defense mobilization signals from Israel. Evacuations are expensive. Military readiness is expensive. Supply chain redirection toward defense manufacturing is inflationary at the margin. Defense procurement consumes silver indirectly through electronics, guidance systems, communications, and solar infrastructure support. Policy pressure plus defense acceleration plus energy instability creates a complex macro backdrop. Silver thrives in complexity. Corporate earnings, miners signal. Now look at miners. Recent earnings reports from major primary silver producers show something interesting. Realized silver prices and financial statements often lag spot benchmarks due to hedging contracts and prearranged offtake agreements. In recent quarters, some miners reported realized prices slightly below COMEX spot averages. There are two explanations. Hedge positioning capped upside participation. Long-term industrial contracts locked in prices before recent strength. The second explanation is more probable for diversified producers with integrated customers. What matters is margin expansion. Energy input costs have stabilized relative to peak crisis levels. If silver prices rise while diesel and processing costs remain manageable, operating leverage improves rapidly. Higher margins allow producers to strengthen balance sheets, but they do not instantly expand supply. Mine development timelines are long. Permitting remains slow. Capital discipline has replaced reckless expansion. So even if prices rise, supply response is delayed. This is critical, because price can move faster than production. Physical market evidence. Now the physical market. Retail dealer premiums are not exploding, but they have stopped compressing despite higher spot prices. That suggests steady demand rather than speculative frenzy. In wholesale markets, delivery wait times have fluctuated in specific bar categories. Industrial buyers have not stepped back materially despite elevated nominal prices. Solar demand continues to scale globally. Electrification trends are intact. Defense electronics consumption is structurally rising. Internationally, pricing divergence has appeared intermittently between Western exchanges and Asian spot markets, not extreme, but notable. That divergence indicates localized tightness rather than broad shortage. We are not in a 1980-style panic. We are in a steady structural tightening phase. That is often more powerful. Derivatives, futures, options pressure. Now, we get to the leverage layer. Open interest in silver futures has been rebuilding, but registered COMEX inventory has not expanded proportionally. When open interest rises faster than deliverable inventory, leverage increases. This does not automatically mean a squeeze, but it means sensitivity increases. Add options positioning. Call option volume has skewed toward higher strike prices in recent weeks. When traders buy out-of-the-money calls, market makers hedge by purchasing futures contracts as price rises. That creates gamma feedback. If silver moves through key technical levels, hedging activity can accelerate momentum. Let's clarify what is theoretical versus probable. A full-scale delivery default scenario is unlikely under normal conditions. But rapid repricing due to gamma pressure combined with macro catalysts is entirely plausible. Most explosive silver rallies historically were not caused by physical shortages alone. They were caused by derivatives feedback loops interacting with macro catalysts. That's the setup we're watching. Connecting all threads. Now connect everything. Policy constraint from sticky PPI. Geopolitical escalation risk from Middle East instability. Defense and industrial demand that is structurally intact. Miners with limited immediate supply expansion capability. Open interest rebuilding faster than inventory growth. Call option positioning skewed upward. None of these alone guarantee $94 silver. Together, they create asymmetry. Silver does not need panic. It needs alignment. If energy volatility rises, inflation persistence increases. If inflation persists, policy flexibility narrows. If policy narrows during geopolitical escalation, capital seeks tangible assets. If tangible asset demand rises while derivatives leverage is elevated, price can overshoot fundamentals. That is how silver historically behaves during regime transitions. The market is not pricing crisis. It is pricing gradual normalization. But normalization may not be the path ahead. Let's step back for a moment and look at the full picture. Over the past 48 hours, we've seen four critical signals emerge simultaneously, signals that most market observers are either underestimating or entirely missing. First, geopolitical tension has sharply risen in the Middle East. Iran's negotiations have collapsed, and Israel has entered visible evacuation readiness. These aren't isolated headlines. They directly affect energy corridors, supply chain reliability, and global risk premiums. Oil and energy markets are already sensitive to the Strait of Hormuz, one of the world's most crucial choke points. Any incremental risk in this corridor feeds directly into industrial input costs and refining margins. For silver, this matters because industrial demand and energy inputs are tightly correlated. Every percentage point of cost shock in energy flows into metals production, directly impacting supply curves. Second, the latest U.S. Producer Price Index, PPI, print was hotter than expected. PPI measures upstream inflation pressures the cost producers pay before products reach the consumer. Sticky PPI implies embedded inflationary pressures across multiple sectors, from construction materials to electronics and industrial components. For policymakers, this creates a dilemma. The Federal Reserve cannot easily cut rates without exacerbating inflation, and maintaining high rates amid escalating geopolitical risk introduces volatility into real yields. Silver is particularly sensitive to these dynamics because it straddles two distinct roles. It's both an industrial commodity and a monetary asset. When real yields oscillate unpredictably, demand for silver as a hedge amplifies. Third, physical market signals suggest underlying structural tightness. Dealer inventories have stopped compressing but haven't expanded. Premiums are steady rather than declining, and industrial buyers continue consuming. Solar and electrification demand remain robust. Defense procurement, already elevated due to rising geopolitical risk, continues to pull silver indirectly. This indicates that despite nominal price levels rising, the market is not in euphoria, it is in compression, a state that historically precedes sharp, rapid moves. The balance between steady industrial demand and limited supply responsiveness from miners creates asymmetry, where a relatively small shock can produce disproportionate price movements. Fourth, derivatives markets are increasingly sensitive. Open interest on COMEX silver futures has risen faster than registered inventory. Call options are skewed toward higher strikes, indicating institutional positioning for upside convexity. Market makers hedging these positions by buying futures introduce gamma feedback into price action. In other words, the system itself is set up for acceleration when macro catalysts hit. Historical precedent shows that the largest silver moves aren't typically caused by physical shortages alone. They are produced by a combination of structural supply constraints, industrial demand, macroeconomic stress, and derivatives feedback loops. Now let's connect all threads and understand what this means over the next 6 to 24 months. From a geopolitical perspective, the risk isn't only the headline conflict. It's the secondary and tertiary consequences. Energy flows may be disrupted partially, intermittently, or even temporarily, but industrial chains refining, transportation, electronics production react immediately. Even small interruptions translate into higher input costs. For silver, this is a structural tailwind. Producers can't simply mine more to compensate. Capital discipline, permitting constraints, and processing timelines prevent a rapid supply response. The result is that silver's reaction function is asymmetric. Small macro shocks can produce outsized price moves relative to immediate fundamentals. From a policy perspective, sticky inflation limits the Federal Reserve's flexibility. High nominal rates combined with elevated geopolitical risk create volatility in real yields rather than clear directional movement. Silver responds positively to uncertainty in real yields because it is a tangible, monetary convertible asset. Unlike gold, which is primarily financialized, silver also has industrial utility, so it benefits from both monetary hedging demand and ongoing consumption. This dual role amplifies its sensitivity to regime shifts. When policymakers face constrained options, markets assign a premium to tangible assets, and silver, being both monetary and industrial, sits at the intersection of this premium. From a physical market perspective, demand remains structurally intact. Dealer inventories are not collapsing, but neither are they expanding, signaling that supply is tight relative to demand. Industrial consumption continues unabated. Solar deployment and electrification trends are accelerating globally. Defense electronics procurement is rising due to regional instability. Even minor disruptions in supply chains or production can shift the market balance dramatically. The physical market is resilient but constrained, a perfect environment for price asymmetry. From a derivatives perspective, the positioning is critical. Rising open interest without proportional inventory expansion sets up the system for sensitivity. Call options skew toward higher strikes, coupled with gamma hedging by market makers, primes the market for momentum if catalysts hit. The key is that this pressure is latent, not yet realized. That means the potential for explosive moves exists without requiring panic buying by retail investors. When the next geopolitical, policy, or industrial shock materializes, silver is positioned to react disproportionately. Now, let's consider how these four threads converge into a unified thesis. Policy, geopolitics, physical demand, and derivatives positioning are aligned. They are not random, they interact. Rising geopolitical risk increases industrial hedging and defense demand. Sticky upstream inflation constrains policy, maintaining real yield uncertainty. Limited minor supply responsiveness keeps the market tight. Derivatives positioning amplifies price sensitivity. These factors together create a market that is fragile, asymmetrically weighted toward upside, and highly responsive to regime shocks. In practical terms, this means that the conventional analysis headlines, retail sentiment, or even short-term technical charts is insufficient. Silver doesn't need an immediate shortage to move sharply. It only requires that catalysts interact with an already compressed and leveraged system. The ingredients for a rapid, non-linear price response exist today. When the next macro catalyst, whether further escalation in the Middle East, an energy disruption, or persistent inflation occurs, the market will likely overshoot expectations before fundamentals even catch up. Over the next 6 months, the key variables to monitor are geopolitical escalation, energy corridors, defense mobilization, and regional stability. Inflation trends, particularly upstream pressures measured by PPI and industrial input costs. Physical inventory dynamics, dealer premiums, delivery timelines, and industrial uptake. Derivatives positioning, call option skew, gamma exposure, and open interest versus registered inventory. If geopolitical risk recedes, inflation cools decisively, and policy regains credibility, silver may consolidate, and the potential for explosive moves would diminish. These are real, non-trivial risk factors that could restrain upside. Conversely, if even two of the current pressures intensify simultaneously, for example, an energy supply shock coupled with sticky inflation, silver's dual role as both industrial and monetary asset makes a sharp repricing probable. Historical precedent suggests that these repricings are sudden, non-linear, and largely invisible until the move is underway. It is crucial to understand the nature of regime shifts in silver. Regimes are defined not only by price levels, but by market structure, policy behavior, and physical constraints. During stable regimes, silver moves gradually, with volatility contained. During transitional regimes triggered by the alignment of policy stress, industrial demand, geopolitical risk, and derivatives leverage, silver can move several standard deviations outside expected ranges within days or weeks. This is not speculative rhetoric. It is observable historical behavior. It's also important to clarify what this analysis is not. This is not a prediction of a specific price target. $94 is a scenario conditioned on regime alignment, not an inevitability. Markets are probabilistic, not deterministic. Silver may move above, below, or sideways depending on the sequence and intensity of unfolding events. The goal here is structural awareness, understanding where risk is concentrated, where asymmetry exists, and where leverage may amplify outcomes. In conclusion, what we are witnessing is a rare convergence. Geopolitical, policy, physical, and derivatives factors are aligning to create a compressed, fragile, and sensitive market. Silver is poised not for gradual drift, but for a potentially rapid repricing if catalysts materialize. Market observers focusing on retail sentiment, daily volatility, or conventional technical charts may miss this subtle but powerful setup. Understanding the structure is the only way to anticipate the market's reaction function. Over the next 6 to 24 months, the silver market will be defined by regime sensitivity, structural leverage, and asymmetric responses. Investors and observers should monitor not just price, but the underlying forces: energy volatility, policy constraints, industrial demand, miner production, and derivatives positioning. Each thread alone is significant. Together, they create an environment where small shocks can produce outsized effects. Silver is uniquely positioned because it is simultaneously a monetary hedge, an industrial input, and a financialized instrument. Its dual identity amplifies its sensitivity to regime transitions. When uncertainty is high and leverage is latent, the market moves disproportionately to the underlying fundamentals. This is why even moderate macro shocks can trigger extreme price reactions. The final takeaway: this is structural analysis, not speculation. The move is not guaranteed, but the setup is visible, measurable, and historically validated. The ingredients for a sharp repricing exist now. Markets respond to regimes, not to headlines alone. Understanding the structure gives clarity amid chaos. As always, remain measured, observe the data, and focus on the forces shaping the market, not the daily noise. Silver's path will be determined by the interplay of policy, geopolitics, industrial demand, and derivatives leverage. Those who recognize this convergence will understand why $94 is not an arbitrary number. It is a potential outcome of a structurally aligned market. This is where the story ends, not with certainty, but with informed awareness. Markets move in regimes, and when regimes shift, the reaction is often sudden, asymmetrical, and difficult to revise. Today, silver sits at that intersection, and the pressure is quietly building beneath the surface.